giving out extra credit if everyone never or right?
Oh yeah.
You have a memory stick or?
Yeah, and a remote control too. It's coming on.
Yep, memory sticks are here on the left-hand side.
Okay. This is their
Well, for some of them it is, for some of them it's kind of like middle of the stream, some, because we admit every single semester, so.
yeah. Okay.
It's a, I think it's all brand new since you last,
Oh really?
well, since you came in to get this topic.
Yeah. Guys are killing me. 8 o'clock in the morning on Saturday. He's dedicated.
You telling us?
And so, I'm assuming it's the PowerPoint one?
Yes.
There it is.
F5.
Perfect.
How do the lights work?
Promote it right here.
Perfect.
Is that okay? That works for me.
We're going to go to sleep.
Let's hope not. All right, folks. This morning, Jesse Holshauser with Silver Companies he's the CFO there. He is one of our MSRED advisory board members for several years. He's also taught in the program, and so I've asked him to come in this morning and talk a little bit about kind of a historical context of kind of the real estate finance and investment markets. And so with that, I'm going to turn it over to Jesse.
Morning.
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 Thanks for coming. 8 o'clock in the morning. How many undergrad finance grads, finance majors? How many econ majors?
Finance minor.
Finance minor works. Econ? Okay. Business undergraduate. All right. Your fresh minds, we can fill you with all kinds of ideas. I called today Dinosaur Day. You're going to hear from the dinosaurs today. Okay. Just a little perspective on the program for those of you that are relatively new. When did we start? How long ago?
2009.
Seems like a lot longer. One of the things that we talked about in designing the program was our desire to get practitioners in the classroom. We didn't want a bunch of 28-year-old freshly minted PhDs to try to teach real estate, okay? And we wanted people with practical experience. So that's what today's all about, is bringing in the guys that have done a couple things. We made a lot of mistakes, okay? And our feeling is, I have one colleague that says he would never do a deal with an older guy who didn't make mistakes, because it means they're not trying, okay? So the key is making sure you don't make big enough mistakes that, you know, it's a big disaster. Although in 2008, the Great Depression, that was pretty hard to do. So get practitioners in the classroom is what this program is all about. I hope you've already begun to see the benefit of that. Hopefully today you'll see more benefit. I'll tell you a little bit about myself. I grew up in a Navy family. My dad was a test pilot, Naval Academy, engineering, master's from Princeton. Imagine that pressure. I was really good at math and science in high school, and everybody said, "You're going to be an engineer just like your dad." And I went, "Yeah." I had no clue what an engineer did. So I get to Georgia Tech. First thing I find out the first week I'm there is it's 90% male. Bad deal when you're 17 years old. Okay. I went there 2 years, took took all the engineering classes, hated it, absolutely hated it. And so I come home after my sophomore year and I'm like, what am I going to do? So, first of all, how am I going to tell my dad that I don't want to be an engineer, right? So, go out for a walk after my second year. Dad, I'm not really liking the engineering. He goes, duh, 2.0 grade point average. It's, you need to find something else to do. That pressure's off. So, what am I going to do? My parents had retired to Fort Lauderdale, where my mom grew up, and what am I going to do? I'm still good at math and science. I just don't like working in the math and science field, right? So it's June of 1972, and it's like 100 degrees and 100% humidity, right? Welcome to Florida in the summertime. And my first decision is I got to get indoors. And none of this construction work or anything else. So, where do you apply for a job indoors when you're 19 years old and don't have any experience? Bank, right? Easy banker hours, nice and cool. So, I didn't know what a bank or savings and loan were, but I throw out 50 resumes. And I get a call from this savings and loan in Pompano Beach, and they said, you're really good at math and science. I'm like, oh, here we go again. And what we've got is a job that we have construction loans. And we need somebody to go out every time the builder asks for a draw on the loan. We need somebody to go out and verify that the work was done. All right, well, I'm not going to be in an air-conditioned office, but I'm going to be in an air-conditioned car, right? So I go out, and I could have done drive-bys. Drive-by, the builder says the roof is up. I could have driven by at 30 miles an hour and said, yeah, the roof is there. But I realized very, very early on that I could stop and get out of the car and talk to those builders and learn a lot. And that's what I did. My productivity with the savings and loan was very low because I was spending all the time talking to builders, buying them coffee, just asking them questions. Probably looking back, a lot of inane questions, but nevertheless, I learned a lot. As an example, and those friendships and relationships have lasted for 40 some odd years. One of my favorite builders at the time was a guy named Jack Abdo. Anybody know who Jack Abdo is? He's the vice chairman of what started out as Atlantic Federal Savings and Loan, became Bank Atlantic, okay, and now called, they have a capital company. If you go over to the Broward Center, one of the big auditoriums is named after him. Great guy. Owns spinning Hondas, and where that came from is, I'll never figure out. But I used that opportunity to learn. And the one advice that I try to give students is, when you finish the program, try to find a job where people are crazy enough to pay you and teach you at the same time. Okay? Don't try, going out, I'm going to make my first $1 million in my first 24 months. It just doesn't happen for a vast majority of people. Find a job that's got mentoring, that's got coaching, where you're going to be smarter 3 years later than you are now. Don't worry about the money. Okay? It'll come if you're really good. So that's one of my advice for today. Mentorship, mentorship, mentorship. We have a mentorship program here. How many of you have a mentor now? Okay? And more will as you get further into the program. Okay? Take advantage of it. Develop those relationships. If you go to conferences or anything, I always tell the students, find out who's going to the conference, find out who the guest speakers are, find out what you can about them, and be prepared with 5 questions for them. Doesn't matter what they are. People love to talk about themselves, all right? And get them engaged. And don't be afraid. Steve Ross is sitting there, the owner of the Dolphins and a lot of real estate. Walk right up to him. He'd be glad to talk to you, okay? All right, so as I said, I started off working for Savings and Loan in 1972. And what I'm going to talk about is all the changes in the real estate capital markets over the last 40 some odd years that I've been in the industry. Okay. these are the key phases of the markets that I've experienced in that 40-year period. During the early years, when I first started off working for the savings and loan, it was very traditional lending. It was easy lending, and I'll tell you why in a few minutes, but very traditional, mom, pa type of lending. Didn't require a lot of brain power, and everybody just kind of did what they were supposed to do. We then had a major crisis with the savings and loan industry during the period from 78 to 86. Boy, what a great time for me to join the industry, huh? To join a savings and loan. Government intervention, we'll talk about financial innovation, Wall Street and all that. The shift of the market to real estate away from stocks and bonds. And we had a little bust in the last few years, if you haven't heard about it. And finally, where are we going in the future? One of my favorite quotes. Those that don't know history are doomed to repeat it. I see this so often, not just in the industry, but in politics and everywhere else. It's just, I got a great idea, let's do this and that. And you say, well, we tried that 25 years ago and it didn't work. Oh, I wasn't aware of that, okay? So, and everyone's entitled to their own opinion, but not entitled to their own facts. Daniel Patrick Moynihan is director of Housing Urban Development under Nixon, a very, very smart guy, Harvard professor, senator from New York, and he was in Congress one day. Somebody was spouting off their opinion, and he came up with this. Everybody's entitled to their opinion, but not their not the facts. And so many times, I see people disagreeing because they're not coming in with the same fact basis. You go in and let's at least agree what the facts are. We may have different solutions, completely different solutions. What are the facts? So that's what today is all about, is let's at least, I'll guarantee everybody here has a different solution for the real estate industry and politics and immigration and all the other issues on the table, but let's at least agree with what the facts are before we start talking about solutions. Okay, when I joined the savings and loan in 1972, basically you had home loans and you had income property loans. What's an income property?
Rental property.
Rental property, anything that produces income, right? Hotel, apartments, office building, self-storage, and all the home loans, both the construction loans, and if you went out and bought a house, you got your loan from a savings and loan. And there were 3,000 or 4,000 savings and loans in the country. And that's what they were set up to do, is they were the single family lender in the United States. Banks didn't make home mortgage loans. Savings and loans did. So, you want to buy a house, you want to construct a house, you go to your local savings and loan, you give them your credit references, normal deal. You got a 25 to 30-year term. There was no adjustable rate mortgages, it was all fixed. You paid a point when you got the loan. You usually got an 80% loan, but you could get up to 95% with a mortgage insurance program. All right? And I like to tell people about my 363 experience. Back then, savings and loans were regulated. They couldn't control interest rates. They were fixed by the government. And the business was pay your borrowers 3%, loan the money out at 6%, and go home at 3 o'clock. It was easy. Okay? Literally, our branches closed at 4, except Friday nights we were open till 7. No ATMs, no Saturdays, no Sundays. We came in around 9, and then we had some coffee and got working about 9:30. Took an hour for lunch. Very, very simple process. On the income property loans, the primary lenders were insurance companies. Banks were not involved in real estate lending for the most part back then. Okay? And the banks made long-term 25, 30-year loans, and that's who you went to get permanent loans on the properties. There was none of this CMBS market and variable rate or anything else. Very, very simple lending. You could get a construction loan from an insurance company if you had some type of, you could get, when you wanted to construct properties, you'd go to a bank or something like that and then make a quick construction loan as long as the insurance company committed to take out that loan. Okay, everybody with me so far? Simple. So what happens? We had this regulation Q. Regulation Q fixed the rates that savings and loans could pay borrowers. Okay? And you couldn't compete on price. You couldn't offer an extra quarter point, you couldn't offer an extra 0.5%. So if you're savings and loan and you're competing with other savings and loans for deposits and you can't compete on price, how do you compete?
Service.
Service? What else?
Fees. More loans.
Sorry?
More loans.
More make loans?
More fees.
Can't charge for fees. Everything's fixed. Okay, the way you competed was service was one. It was where the location of your branch was. People are not going to drive a long way to a branch and pass 3 other branches of 3 other savings and loans. So the deal back then was build as many branches as you can. And what kind of branches were they back then? What are branches like today? You see them everywhere, right? Standalone properties, you see them in retail centers, you see ATMs everywhere else. Back then, you had to promote the safety and security of everybody's money. So you built these big 2-story mausoleums, okay, that stood alone. And you see the remnants of those around here in Broward County. So that's how we competed. How else can you compete? It's early, right? We used to give away gifts. Jewelry.
That's where those toasters came from.
Toaster ovens. We gave away, or I think, a $25,000 certificate of deposit, which was a lot of money back then. You got a fake diamond, big, like 2 or 3 carats. And you'd see these women like in their 70s walking around town. But I never said it was fake, right? I swear the lobby was full of toaster ovens and jewelry. Okay? That's how we competed. Branching, number 1, service was important, and jewelry and toaster ovens. Now, Regulation Q says fixed rates. No matter what you do, you can only pay so much on demand deposits. And you say, okay, well, maybe I can make loans at a lower rate than everybody else, but when I make those loans, I can try to get deposits from the borrower, right? I'll make you a $100,000 home loan, but I want you to put $5,000 in the CD. A, you weren't allowed to do that, and B, Regulation Q was a federal requirement, a limitation on what you could pay. Each state, for the most part, had a limitation on what your borrowing rate could be. So you're stuck. I can only pay 3% of my deposits. I cannot charge more than 6% on the home loan. How do I compete? Service, branching, and fake diamonds. All right? Believe it or not, this depression we just went through was not the first one. It was my 5th recession depression since I've been working. You get to the late 60s, and we're spending a fortune on the Vietnam War and on Lyndon Johnson's Great Society programs. And we're starting to run a deficit for the first time in the history of the country, other than during wars. Sound familiar? Yes. Okay. So, on top of that, we had 2 energy crises in the 1970s. We had an Arab oil embargo in 1973. Now, bear in mind, I'm in my 2nd year with the savings and loan, and I'm driving around in a car doing construction inspections, and there's no gas. How am I supposed to do that? Well, it turned out one of our vice president's husband owned a gas station. So we got our gas. But it absolutely killed me because the price of gas went from 25 cents to $1. Oh man. But it was a big impact on the economy. Second thing that happened was you had the Iranian Revolution in the late 1970s, and crude oil prices went up through the roof. Okay? And so what's happened, and the more oil prices are going over to the Middle East, sucking money out of our economy. So we're running a deficit on Vietnam, we're running a deficit on the Great Society programs, and we're sending a bunch of money over to the Middle East. It's not a good formula, right? Now, not that politics ever had anything to do with policy and the financial policy in this country. We got in the 1972 election. Who ran in 72? I got any political science undergraduate majors? Nixon and McGovern. Okay? Nixon wanted to stay in office. All this is going on. What's he do? And he hadn't figured that one out. Okay. Inflation, by the way, inflation is starting to take off because of deficit spending, these energy crises. And Nixon's like, that's not a good formula to get reelected. All right? So he puts pressure on the Federal Reserve. And he says, you've got to keep interest rates low. And the economists are all saying, when we have inflation, we've got to increase interest rates. And nobody's going to invest in our country. If our currency's going up 10% a year in value, and our interest rates are only 5 or 6%, nobody's going to invest in our country. Okay? Their investment will go down every single year. Nixon said you can do anything you want to after the election, keep the interest rates low right now. And they did. They fell to that pressure. And it also kept employment high because they were able to moderate some inflation. Here's what happened with inflation. Okay? Here we are in 1974 and 1975, after the election. True his word, after that election night, he was done. He said, you guys can do anything you want to. I got in for my second term. Nobody can hurt me. Forgot about Watergate, but nobody can hurt me. So here's what happened to inflation. What number is that? That first circle. How big is that? 12%, right? How'd you like to have your prices go up 12% a year every year? Okay. What's it do to your confidence? Okay. And then that Iranian Revolution and the crude oil, you can see the second one there, it actually got above 12%. And what's happened since then? Down to the early 80s, and it's continued to decline. Do you know inflation right now is only 1.5%? Somebody forgot to tell me. Okay, but it's how they measure it. So, that's what happened. Now, your savings and loan. You're paying 3% on your deposits, and you can't change that. You're lending money out at 6%, and you can't change that. And all of this is going on. What happens? Money leaves the country. Investors say, I'm not putting my money into this country. I'm going to take it somewhere else. All right? And all of a sudden, it didn't matter how big that fake jewelry was, we were not getting any deposits in. If you don't get any deposits in, how many loans do you make? None, right? Okay. So, again, investors sought other investments, at least outside the country. Even those in the country decided to invest in different things other than putting their money in a savings account. Now, your savings alone and you're panicking. What do? Well, let me diversify. I'm going to get involved in things other than real estate lending. And so they set up these subsidiary companies that supposedly were separate from the savings and loan, But they set up these subsidiary companies to get involved in all kinds of stuff. They got heavily involved in developing real estate themselves, even though none of these guys were developers. They got involved in just a bunch of crazy businesses. Now, it's whatever it is, late 70s, I guess, and it's a disaster. And there's a very confidential meeting involving the White House, congressional leaders, Federal Reserve. And they all get together and say, our savings and loans are failing. And to rescue them right now would cost $25 billion. And everybody went, oh, $25 billion. We can't tell the American public about this. They'll kill us. They'll impeach us. We've got to keep it quiet. So they deferred and deferred. Finally, they decide, let's deregulate interest rates. So at least the savings and loans can go out and pay a lot higher money and try to attract those deposits. So they deregulate interest rates, and now instead of paying 3% and giving fake jewelry out, savings and loans are paying 10 or 12% on their money. One problem. What's the problem? Got money coming in now.
You gotta loan it out at a higher rate.
Loan it at a higher rate, yeah. What's my other problem? All those loans I made at 6% are still on my books. So now I'm paying depositors 9, 10, 12% to finance my 6% loans. How long is that going to last? You're losing money, okay? And that's really what that secret meeting was about, was our deposit, we deregulated deposit rates. We've got this mismatch going on. The savings and loans are losing money. Here's an example on the right side. You have $1 billion savings and loan, we call them thrifts as well. And let's say their deposits are $900 million and you have equity capital of $100 million. And let's say their loan portfolio is yielding 8%. And they're paying 14% on their money. They lose $60 million a year. What's their capital? $100 million. How long before you run out of money? 2 years, right? Okay. So now what happens? They're insolvent. We're keeping it quiet. What do? We're kicking the can down the road. Okay, more is going on. The savings and loan owners, for the most part, were the big business guys in each community. The car dealers, developers, other people that had gotten together with all their buddies and said, let's create a bank. Let's create a savings and loan. They were very politically, well connected politically, and they had convinced Washington to ease up on examinations. And back then, savings and loans were examined by different regulators than banks were. That's not the case today. So you got that. What did I tell you about branching? That was the way you competed with it, okay? So whether they allowed lots more branches or they allowed new savings and loans to be created, there was this proliferation of savings and loan branches around the country. These guys were automobile dealers. These guys were lawyers. The savings and loan that I worked for was owned by a lawyer. He didn't know anything about money. He was a smart guy. The whole reason he formed the savings and loan was because he did all the legal work for it. And he had about 20 lawyers on the staff that did nothing but the loans and everything else for the savings and loans. Regulatory capital requirements. When we had the secret meeting, they said, well, if we don't tell the American public, what are we going to do? How do we kick the can down the road? We'll say that you don't have to put maintain as much capital. So we'll let you eat into that capital, and hopefully that problem will go away someday. You know, you have the FDIC today to protect you against the failure of a bank. Back then, you had a separate thrift savings funds, insurance fund, the same kind of thing. And the federal government's supposed to fund it every year, and they didn't do it. And they postponed the requirement that the savings and loans make deposits to it as well. Bad economy, lax enforcement. There was a tax act in '86 that killed a lot of the lending. Bad stuff's going on, all right? So, remember the secret meeting? What couldn't we tell the public? How big was the loss going to be? 25 billion. 441 thrists with 113 billion in assets were booked and sold. 533 had capital no more than 2%. And here's what happened. Finally, the government stepped in. They funded the insurance fund. FDIC took over regulation. Right? 1,043 savings and loans went out of business with assets of $519 billion. Number of institutions declined 50%. Now what do you do? All right, finally went public with the public. We got a disaster on our hands. We got savings and loans failing like crazy. All right. What do? They're saddled with all these bad mortgages. Government did something I think was very, very smart. We all hated it at the time, but looking back on it, it was a very smart thing. And what they said was, look, if we don't do something, these savings and loan owners and managers are going to spend the next 10 years working out these problem loans. And they're not going to be focused on new business, new lending. So let's take all these bad assets, we'll take them off the books of these savings and loan, and we'll put them into a government-controlled entity called a Resolution Trust Corp. And that'll allow management no longer has to focus on any of that stuff. We just took their loans right off the books, put them into a government-run organization, and they hired a bunch of subcontractors from the industry to manage these portfolios, and they worked their way out. Some of these weren't resolved for 8 to 10 years. But it's very smart, I think, on the part of whoever did that, to say, let's take all these problem loans and take them away from these inexperienced people. Let them get back to doing what they do best, and we'll take care of things. That $25 billion they were afraid to tell people about back then turned into $124 billion. That was the taxpayer bailout of the savings and loan industry. Moral of the story: be careful anytime you work in an industry or in a business that's affected by government regulation. Okay? There's not a lot of common sense applied by the government. Anytime you get to a political environment, you're going to have a problem, or you could have a problem. I have a friend who was CFO of a large nursing home company. Government came in one day and said, Medicare costs too much money, we're going to reduce your reimbursements by 20%. We're just going to cut your revenues by 20%. Okay? He said, I'll never ever again work in a business that's regulated by the government or could be affected by the government. Next thing you know, he becomes president of a prescription company, one of these mail orders. He's there like 12 months. These are costing too much money, we're going to cut your reimbursements. Here we go again. So he says, once again, I'm never working in a regulated environment, ever again. So the next thing you know, he becomes CEO of a for-profit university. What's going on with government regulation of for-profit universities these days? They're all over them, right? Okay? He can't get away from the government. So, lesson learned, be very, very careful about any time you're in a business where you can be affected by the politics. So that was kind of the first phase, was we went from this very simplistic lending to all of a sudden the world turned upside down, and we figured out very quickly, or learned, that the United States is part of a big world, and stuff that happens that we can't control, oil prices, Iranian Revolution, whatever the case might be, we don't have a lot of control over those events, and they can affect our country a lot. That was a big, big wake-up call to the real estate industry. Before then, it was very much in the United States. We got our money in the United States. It was all self-contained, and all of a sudden, boom. I would dare say it was a wake-up call for every industry, not just real estate. All right. So, we go through this experience. Interest rates are starting to get back to normal. It's like, and we put all the bad loans into the RTC. Time to get on with business, right? Woo, we kicked the can down the road. We got it resolved. Let's go forward. Who's going to make real estate loans? There's not many savings and loans left, right? Half of them are gone. And where are they going to get their money? They've got so much pressure on them from regulators about doing the right thing. They have difficulty making a lot of money. So the federal government says, uh-oh, without home building, without an active mortgage market, we're going to have problems with this economy. I know. Who's got money? Banks. Let's go to the banks and say, we want you to be the mortgage lender of first resort now. Forget about these savings and loans. More are going to go out of business. Okay? Mr. Banker, I need to talk to you. He says, wait a minute. I just saw what happened for 10 years with the savings and loans. And you want me to do the same thing? Nah, not going to do it. So, government says, how do we make it worth your while? All right? How do we avoid a repeat? And the banker says, look, they have what they call, they match their maturities, which means if you're loaning money out for 30 years, you should have 30-year deposits, so there's never a difference. The banker said, our money comes in, a lot of it's overnight money, maybe 1 or 2 year CDs. We don't get money for 20 years or 30 years. I'm not taking that interest rate risk where I've got that portfolio of 6% loans, and I wake up one day and I'm paying 10% of my deposits. Okay? So, the government says, you need to get rid of your mortgages. All we want you to do is make the mortgage, but then get rid of it. And the bankers say, I don't know how you're going to do that, but that's a great idea, because if I have $100,000 and I make a $100,000 loan for 30 years, I used all my $100,000 up for 30 years, right? If I can make a $100,000 loan and sell it to somebody within a month, I can use that money every single month, and I can make $1.2 million of loans, not $100,000 of loans. That's a good deal, right? Same $100,000 being used to make 12 loans a year instead of 1 loan a year. And the banker said, I like that. And they said, oh, by the way, you keep the servicing rights, which means even though they sold off the loan, they retain, that's who you still send. You send your payment to Bank of America, even though somebody else owns the loan. And they make money servicing loans. So, government says, why don't we create this thing or use this thing called Freddie Mac and Fannie Mae? Government institutions, sponsored institutions. And what they'll do is they're going to, let's see if I think I've got a slide on this. Yeah, here it is. We're going to have them go to the banks, as long as the bank complies with all the regulations, within 30 days after a bank makes a loan, Fannie and Freddie will buy that loan. Get it off the books, the bank's free to use that $100,000 to make another loan. Okay? Fannie and Freddie then said, well, we can't use taxpayer money to do all this. Where are we going to get money from? And they said, I know. We'll guarantee the loans and sell them to investors. Okay? Through Wall Street. Now, how do you think Goldman Sachs liked that? Somebody just gave me a gift from heaven, right? Let me get this straight. The bank's going to go out and make a mortgage loan. Fannie's going to buy it, put an insurance wrapper on it. I get to go out and sell it to investors. And of course, I'm taking my fees and participations all along the way. What's not to like? Right? What's the risk? Banks happy? Sure. Goldman Sachs happy? Okay. What's the risk? Franklin Raines, a former congressman, CEO of Fannie Mae, read his 2001 annual report for the Fannie Mae annual report. That really came true, didn't it? Fannie Mae buys the loans, puts an insurance wrapper on it, sells it to Goldman Sachs to market to their investors. What could go wrong? What could go wrong is if the loans are a problem and people are calling on that insurance policy, right? That was the thinking at the time. Loan prices or home prices go up every year, right? They never go down. Never. Whoever heard of such a thing? All right. Now, I'm gonna find another slide here. Well, the gist of it is, Goldman Sachs does what only Goldman Sachs and Wall Street can do, is they say, boy, we got a deal for you investors, okay? You get federally insured mortgages. What's better than that? And at the same time, what's happening is investors are not doing too well in the stock market. There's a stock market, okay? Worldwide crisis, economic crisis. Goldman Sachs and Wall Street convince all these investors, get out of stocks and bonds. There's too much variability. You can see all this going up and down. People were shocked at what was going on. So there's a flood of money going into these real estate mortgage pools. Now, firms like Goldman Sachs and other good Wall Street firms, they employ a bunch of mathematicians. And they're all Harvard, MIT, they're up in Boston. And they put them in these rooms and they just say, see what you can figure out. And the mathematicians will say, figure out about what? Whatever. We're going to open our files, see what you can figure out. One day, a guy comes in and he says, I've been looking at these mortgages that we're selling off, these 30-year mortgages, and I've been looking at the bond market, because that's the alternative. Instead of buying a mortgage, you can just buy a bond, right? A treasury bond or an IBM bond or Apple bond, whatever the case might be. And he said, we can chop this thing up into pieces. And if you add what we could sell each piece up for, we could sell them for about 3 or 4% more than the amount of the mortgage. So we could take a $100,000 mortgage, cut it up into pieces, and sell it for $104,000. That doesn't sound like a lot of money, right? $4,000? Well, think billions and billions and billions of dollars. Okay? The MIT mathematician who doesn't know anything about the stock market figures this out one day. And he says, but I got one problem. You know, some people want flat payments for 3 years, some want it for 7 years. Nobody wants to invest after 10 years. I don't know. If I'm selling all this other stuff off at a profit, what do we do about all the mortgage payments for years 10 to 30? Nobody can figure it out. All of a sudden, a lawyer, not a Wall Street guy, a lawyer sits there and says, why don't we just make all the loans a 10-year balloon? There will be no payments due after 10 years. Okay? You're getting a loan with a 30-year amortization, but it comes due after 10 years. We're going to talk about the CMBS market in a minute. And that's what they did. And so they started chopping all this stuff up into multiple tranches. I've seen on issues with as many as 25 different tranches. Taking the mortgage, cutting it up, some principal, some interest, some flat payments, some short-term, some long-term. Now we got Wall Street involved in the real estate industry. Okay? Does Wall Street know how to underwrite real estate? Let me give you, I'm going to jump forward for a minute. Okay? We get visited by Goldman and a lot of other firms all the time. And they're typically, there's a senior partner, a junior partner, and a 28-year-old analyst more often than not from Wharton. Okay? And then we want to invest in your stuff, we want to buy your properties, we want. Okay, let's talk more about it. All right, deal with a 28-year-old analyst who's never been on a real estate job in his life, never developed anything, and they're the guys that we have to talk to. We had a bond issue a couple years ago up in Virginia, and had a couple of the analysts in. We presented the whole project, 350 acres, hotels, retail, the whole deal. We're all done and said, are there any questions? One hand goes up. It says, can you tell me how high the curbs are in the project? I've been doing this a long time, but I don't know how high curbs are. I don't know why it matters. Okay? These guys have no idea. How does Wall Street make money? Transactions. They don't bet on one side or another, or they bet on both sides. They want fees. That's what they were doing. Cut up the tranches, the mortgages and the tranches, sell them off, and we'll make money. And I don't care if the mortgages fail or not, because why? Government insured it, right? And that's not a risk because real estate never goes down. All right, so you got a flood of money, you got Wall Street involved in real estate, and here's what happens in the 2000s. Okay? Savings and loans are gone. Most of them converted to banks. So you got banks you're dealing with. Your residential loans, you can get a 5-year loan, you can get a 30-year loan, you can get a variable rate in your arm, you can get a fixed rate. It was a cafeteria. You get any kind of loan you want to. Again, the bank made your loan within 30 days. They sold it off to Fannie or Freddie. Fannie or Freddie collected all of them, put them in a pool, sold them off to Wall Street. Okay, the banks retain the servicing. On permanent loans, this whole thing is called CMBS, collateralized mortgage securities. Life insurance companies are somewhat active. They're starting to get a little more active. They make 7 to 10 year loans, 75 to 80% LTV. So what happened? We had this crash, right? How could we have a crash? Had the whole thing set up. Banks are making mortgages left and right. Fannie's buying them all. Wall Street's buying them from Fannie. It's perfect. Billions of dollars. What happened? Okay. You all tell me, what do you think happened that caused this big real estate crisis starting in 2007, 2008? What's the conventional view?
Well, they start defaulting on the loans.
Yeah, why?
Default. Because it was subprime loan.
Subprime mortgages. What does that mean?
It means they were money was lent out to people who shouldn't have had money lent to them.
So an overvaluation of the future value of the house, so they justified the subprime lending under the assumption that the property would appreciate.
So these lenders went out and took these poor, hapless people that didn't know better and forced them to borrow all this money, right? Even though they didn't qualify. These poor borrowers, okay? And we went to them and we said, even though you only make $50,000 a year, we're going to give you a $250,000 loan, right? Who did that?
All the banks, but.
The banks? Nah. No.
People.
Next guess.
I think I just got caught up on the hype of
Who was the biggest subprime lender in the United States? Anybody know?
Countrywide.
Countrywide. Are they a bank?
No.
No,
No. Who are they regulated by?
nobody.
They weren't regulated. Okay. Bank of America could have never gone out and done subprime loans with people. They had examiners on them all day long. It's not what they do. Okay. Now, it was the subprime lenders were, for the most part, non-regulated lenders. Countrywide is by far the biggest in this whole deal. Okay. And you got this irrational exuberance, they call it, and people got all in the hype. And Countrywide was, everybody saw Countrywide was making a fortune. And so other non-regulated companies came in for the most part and started doing the same thing. All right? What was going on overseas?
Buying the loans?
Yeah, I mean, people, investors, both United States investors and foreign investors, looked at all this and said, what Franklin Raines said, real estate goes up every year. I'm not making any money. There's all this political turmoil. You got the Middle East going on. Europe's got growth problems. Looks like the United States is a pretty safe place to put my money. But I think I'll buy mortgage bonds. Because, why? You're insured. How good is that? You got no risk and I can invest my money. Everybody started getting greedy. Let's do the subprime loans. Look at how much money Countrywide's making. Let's get involved in that. Okay? When there's money to be made, who shows up?
Sharks.
Wall Street. Wall Street's always there. They can sniff that money miles away. And they said, let's get involved in it. A lot of this, whether it was Wall Street directly or through firms that they backed, Wall Street got a flood of capital coming into the market. Now, what do you know about supply and demand? There's more money coming in and only so much real estate. What happens to real estate pricing? It goes to the roof, right? Okay? Now, those of us in the industry are looking at all this, some of us, and saying, I've never seen anything like this in my life. House prices are going up 5, 7, 8% a year. Money's cheap. This can't continue. And that lasted about a year, and then we all said, maybe we ought to get on this train while it's still going. Okay? And people, I'm going to include myself, that knew better, said, and just kind of lost their common sense and their intuition and all their things that they had learned in the industry and said, I'm going on for the ride as well. Okay. Those hapless individuals were then supposedly unable to make the higher monthly payments when their mortgage rates reset upwards. We gave them teaser rates at 2.5%, and they didn't know, even though it was on the first page in big letters, they didn't know the mortgage rate was going to jump to 5%, their mortgage payment was going to jump 10% in the first year. Everybody started buying homes. Home ownership went up 4%. Now that doesn't sound like a big number. That's a huge, huge increase in this country. I mean, we've been at, whatever it is, 60, 62% for so long. All of a sudden, do I have it up there? Yeah, 4%, up to 69% in 2006. Okay, and what was Bill Clinton saying at the time? He was out promoting home ownership. Nothing better than people owning their own homes. They get fixed in the economy. They get involved. It motivates them to be involved in the economy. You got all the investor money coming in. All of a sudden, you start getting some delinquencies. People are not paying. Foreclosures start up, and almost overnight, the whole housing market just imploded. I mean, it just came to an absolute dead stop. Tony Cello, who'll be in here at 10 o'clock, he'll tell you, he's involved in the residential land business, and he'll tell you, home building business. He'll tell you about what happened back then. The lenders all get in trouble. Here we are with the Great Depression. Now, that was kind of the conventional view, and that's what happened. I like to summarize it by saying this. Everybody lost their mind. Okay? We did, the industry did, the lenders did, Wall Street did, the government did. Okay? Nobody thought this thing through. The biggest factor in why somebody would default was not the payments, but more, the vast majority of defaults they found, somebody got upside down in their house, right? They owed $250,000 and it was only worth $150,000. If you got a $250,000 mortgage on a house that's only worth $150,000, at what point do you just say, heck with it, I'm walking. I'll go next door and buy that house for $150,000 and start all over again, right? And so they started to default, not because of cash flow, that was some of it, but mostly because they're like, why should I do this? Did they get away with it? The banks let them get away with it. Very, very few banks went after these borrowers. You would go to, anybody do any short sales here in South Florida? What would happen is you go to the lender, first of all, you got to start making your payments to get their attention. Okay? And then you knock on the door and you say, I can't make the payments anymore. And the lender would argue with you for a while, a couple more months of missed payments, which you're banking, by the way. And they finally say, look, go ahead and put it on the market, see what the best price you can get, and we'll look at it. I got $150,000. All right, well, how long was it on the market? It was on the market 4 months. How many people looked at it? 30. All right, looks like that's about the best price you're going to get. We'll write off that $100,000, you're free to go. The early ones all of a sudden wake up and realize all that forgiven debt is taxable. What did the federal government do? Waived it. Continue to waive it. Hey, Tony. So the government helped reinforce this whole process and said, go ahead, quit making your payments, get a write-off, the bank won't come after you personally, and we're not going to tax you on it. How good a deal is this? I can stop making my payments, save on my payments for 6 months, I can go next door, buy the same house for $150,000. Okay, and that's what happened over the last couple of years. Mortgage market 2007. Prime fixed loans. Who makes prime fixed loans? What's a prime loan? Somebody is qualified, it's got the credit, they go through all the standards, no more than 28% of your income goes to a house, 38% of debt. They accounted for 63% of all the mortgage loans, but only 17% of the delinquencies, the foreclosures. They weren't the problem. Where was the problem? Subprime variable. Who made them again? Who made those loans? Not the banks. Not the regulated companies. Countrywide and and money from Wall Street. And there's for those of you that are interested, that's the article on the fact being upside down was much more important than whether you had a cash flow problem. Okay? Let's look at residential real estate prices. This is 2000 at the beginning. There's the run-up. The blue line is single family, and the red line is multifamily apartments. Okay? What was going on? In January of 2000, we started the index at 100. Where did the index cap at? 200. And went. In 6 years, house prices doubled. That's normal, right? Crazy. Looking back on it, you say, if you were in the industry, you were nuts to buy into this, right? We all did. Or a lot of us did. There's some smart ones that got out at the right time. That's that because of all these factors. All this money coming in, subprime loans, irrational exuberance. People were, we had a guy on our staff in Virginia that made $50,000 a year. He bought 2 homes, $150,000 each. I'm gonna flip them in 6 months. And he did. He made a bunch of money. Who in the right mind gave 2 $150,000 loans to a guy making $50,000? That's the kind of crazy stuff that was going on. Now, what happened? All right, we have the Great Depression, 2007, 2008. House prices go down big time. Multifamily go down big time. Now what's going on? Here we go again. Okay. Who won? Everybody won early on until we had the Great Depression. So we have the Great Depression. Again, just like the RTC days where we had all these bad loans, we got bad properties. Lenders are trying to get rid of them. They're doing workout loans, short sales, all the rest of that stuff. And it's like, okay, we're never going to do that again. Okay, let's all be smart going forward. Let's get back to traditional lending like when I started with that savings and loan 40 years ago. You got to have credit. Okay, you got to obey the standards. You got to put up equity. And let's obey this. And if we start seeing a period where house prices start going up like crazy, put the brakes on, stop all this nonsense. And that's what happened for a while. Where are we today? Apartments are selling. I think I've got a slide here. The red line are apartment cap rates. As cap rates go down, what happens to the price? Goes up, right? Okay. In 1990, cap rates were around 9%, and now they're down. That slide says in 2013 they were at 5%. We're seeing multifamily now selling as low as 4% cap rates. Okay. Now the blue line is the 10-year Treasury, and for most of the time, there's about a 4% difference between the cap rate on apartments and the 10-year Treasury. 390, 400, 390. What happened in 2007, 2008? It really narrowed. So what that says is people were not getting paid enough premium to take the risk of owning real estate. Investors want about a 4% premium over federal 10-year rate, and all of a sudden they're willing to pay such high prices that they're not getting paid any premium. Well, but then we go through the Depression, things start reverting back to about 4, here we are at 400 again. By 2013 we're at 275, and we're about 3.5%, 4% right now. I'm sorry, we're at about 2% right now. 200 basis points. We are way below what the historical average has been. In my 40-year career, the average cap rate in 40 years has been 7%. I'm sorry, the average borrowing rate has been 7% on apartments. The average return on equity was 10, and the average cap rate was 9. Okay, so over 40 years, we were paying 7, earning 10 on our equity, and the cap rate was 9. Okay, imagine if this industry ever returns to those kind of normal rates. What's going to happen if you buy a property at a 4% cap rate and it becomes, forget about 9%. Let's say cap rates go up to 6%. When were we at 6? Okay, not that long ago. What happens to your value of your property? You buy it 4, Cap rates go to 6, what happens to the value
A lot
of
of
property?
money. The value's a lot of value.
You lose, like, what is it, a third or 40%, whatever it is, of the value of your property. What's going on? You got a flood of money coming back into the real estate industry through Wall Street, real estate investment trusts especially, Goldman Sachs and the rest. And what do we say about supply and demand? We got too much money chasing too little product. Okay. Prices are starting to really go up. Cap rates are going down. We have 28-year-old Wharton analysts making investment decisions. Okay. They don't care what happens in 10 years, whether it performs or not. Where are they going to be in 10 years? Running their own hedge fund, right? Or taking out the trash, whatever the case is going to be. On the multifamily side, we have what we call the elephant killers. Does anybody know what I mean by an elephant killer? You're a hunter, you got a gun. It's pretty easy to kill an elephant, right? Like this big thing and you can shoot it. And that's where this institutional money is going after, is new apartment buildings, suburban for the most part, and the south and the west for the most part. And they're all chasing the same product. So we got two supply and demand problems right now. We got too much money, too little product, and all this money is chasing product in very narrow areas. Okay? What happens when supply and demand are out of balance? Not good stuff, right? Easy loans, cheap money. It's all about OPM. What's OPM? Other people's money. Okay? It's not my money. If an investor from Israel is crazy enough to go ahead and buy apartments at a 4% cap rate, I'm crazy enough to sell it to them. I'll go find it. Don't care. It's not their money. Don't care what happens in 5 or 10 years. Senior care. Senior is very active right now. I don't know anything about industrial. I don't know if any of the speakers today do. A couple members of our advisory committee are involved in the industrial sector. They swear by it. It's just something I don't understand. Retail is a huge problem right now. The big box stores are basically done. The big box retailers are trying to come up with smaller, boutique-y more type of stores. They haven't figured out how to do it. Wall Street, we deal with Wall Street, Walmart. Walmart told us that they're basically in 97% of the markets that they would like to be in. They've just about run out of places to put them. The one exception is they're not in urban areas. There's no Walmart in downtown Pittsburgh or downtown New York or Chicago. Why?
Competition.
The land. How do you get a parcel that big in Manhattan or Chicago? What's the solution? What did the old downtown department stores do? It went up in the urban areas, right? You had a 10-story Wanamaker in Philadelphia or wherever you were. Macy's, they all went up. So Walmart says, let's try it. The guys at Walmart are very, very sophisticated, smart people. They have done about 7 or 8 of these. They have not figured out how to get people off the first floor. Sounds stupid, right? People don't. There's like this physical barrier. Like, why should I go up? They actually went out and found a bunch of 80-year-old retired department store guys. And they're trying to work with them right now to figure out how did you get people to go up to the 3rd floor and the 4th floor and the 5th floor. It'll be interesting to see what happens. Retail is a big mess. You go past these strip centers with a Hallmark and a pizza, and they all look full, and they are. Nobody's paying their rent. Okay? Would you rather have a pizza place paying 50% of their rent or leave and be empty? Sure, you're going to do whatever you can. Retail's a mess. Hotels, hotels are operating businesses. They're not real estate. Okay? In Europe, hotels are real estate because the owner leases the property to an operator. Like leasing a Walmart store. How are you doing on time? Good. Fred will circulate the slides. This is just more about other people's money. All right. The math wizard comes in from MIT, figures out they can tranche. They do the 10-year deal to solve their problem, right? Every loan comes due in 10 years. So rather than paying these loans off over a 25 or 30-year period, every single loan comes due in 7 to 10 years. Okay, we got a huge maturity problem coming up in this market, this mortgage market. Here's 2014. We're looking at about 35, $40 billion of loans maturing. Look what happens the next 3 years. All those loans are maturing. What are the borrowers going to do? My loan's coming due in a year. My loan's coming due in 2 years. All right.
So,
I got to refinance, right? Or I got to sell. You're starting to see a lot of people sell. By the way, there's huge prepayment penalties on these loans as well. You only get about a 3 to 6 month period where there's no prepayment. We just sold a portfolio of apartments, $250 million portfolio, $200 million of debt, $250 million price. We weren't going to sell them for 2 years because that's when the loans come due. We found a buyer who's willing to take that on now. He had to pay a $25 million prepayment penalty. Now he's willing to do that. It's huge, okay? But we've got a lot of money is going to get sucked out of the economy as people either sell or refinance these properties. Now what happens, this all looks fine and good right now, right? I can go refinance the loan anytime I want to. What happens in 2 years if interest rates go up 200 basis points, 2%? How do I even know it's going to decrease the amount that I can refinance? I may not even be able to refinance it for enough money to pay off my first mortgage, right? The cash flow goes down. Well, how do I even know there's going to be a capital market in 24 months? What if there's some world event and money dries up? Okay? Are there any world events going on right now that could impact our world? Yeah, all over the place, right? A couple wars going on, a lot of uncertainty. We got it's going to be interesting as we work our way through this over the next 4 years to see what happens. There's going to be a lot of political pressure, keep interest rates low, maintain the capital markets. Sound familiar? Mm-hmm. Nixon, 72, full employment and keep inflation low. Okay? Apartment cap rates in the second half of 14, historic lows. Let's see some key data here. There's so much capital pouring into these big 6 markets. Remember, money chasing South and Western properties new, or pretty much new. That even if many investors are concerned about valuations, there's plenty of investors still competing fiercely. Cap rates fell to 4.4%. That's a historic low before 2006. What was 2006? Just before the Great Depression when we had this price run up. Okay, yields for mid-high-rise properties reached 3.9%. Okay. I can invest in a 10-year treasury and get 2% right now, 2.2%. Or I can get real estate with 3.9. Am I getting paid for my risk? Well, for the last 30 or 40 years, investors said, I want at least a 4% premium because there is risk, right? There's always risk with real estate. You're not getting that today. Last thing I'll talk about is I get a question a lot about unemployment rates. This is time going across from 1950. Each shaded bar is a recession. As I said, this is my fifth recession. What happens just before the recession to unemployment? Typically, it's down, 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 and then what happens after the recession?
spikes.
Spikes, and what happens then? Spikes, goes down. Spikes, goes down. Spikes, goes down. Spikes. This chart ended at 6. They just announced unemployment yesterday at what? 5.5. Okay. Now, some people say it took too long for it to go down, but what we're seeing is what has normally happened over last 60, 70 years of this country. We get really good employment. That some event, it might be oil, it might be war, whatever the case might be, irrational exuberance, too much money going into real estate. Boom, unemployment goes up, comes back down. You also hear a lot about the participation rate. It's not just the unemployment rate, but how many people are actually working. There's a lot more to that data, okay? A 40-year-old Amazon guy who cashes in his stock options and stops working, he just went from the participation to the non-participation. Is that a bad thing? Okay. Okay, and you get, increasing number of homemakers, people living at home. There's a lot, but it's real easy. It's a 15-second soundbite. Oh, the participation rate continues to decline. Well, get behind that data before you just start buying into that. Stephen Wright, the comedian. We're right back to where we were in 2006, 2007. Prices are down, money's cheap, too much money after too much product, too much money after a limited amount of product. Right now I'm having amnesia and deja vu at the same time. I think I've forgotten this before. Okay, here we go. What's happening to home prices in Broward County? What's the newspaper say? We're all happy, right? The headlines? House prices, condo prices went up 5%. Yay! Okay. Should we be saying yay? Careful. Okay. I got just to show you the impact that Wall Street can have. First of all, I've got a hand up. Got a test. Pass this out. Ask you to do the same. I'm going to show you how a real estate investment trust works. All right, you got a real estate investment trust. Start off with some facts at the top, okay? Everybody got one? The REE buys a portfolio of properties, and their NOI is $7 million. Everybody know what NOI is? Yeah. Okay. And they're buying them for a cap rate of 7%. All right? Got it so far? Now the REIT's administrative costs are 5% of NOI, and their capital expenditures are 5% of the NOI. And the investors in the REIT want a 3.2% dividend yield. So whatever the cash flow of the REIT is, they're willing to pay a price as long as it yields a 3.2% return. And management owns 20% of the REIT through stock options. Everybody good with the assumptions? So I would like to spend a few minutes answering the questions in the analysis. What's the purchase price? What's the net cash flow? You can see them there. And then we'll go over them and show you how REITs are really working in today's environment. Yell if you need help. Okay, what's the purchase price? 100 million? What's the net cash flow?
6.3.
Everybody got that? You got $7 million NOI, 5 is going to admin, 5 is going to CapEx. That leaves $6.3 million. What's the stock worth? I'm getting a lot of mumbles. If the cash flow is $6.3 million, and investors want a 3.2% dividend yield, what's the REIT stock worth? 196 million, right? How much does management own? 20%? How much profit did they make? Got 196 million worth of stock, spent $100 million. So the profit's what? 96 million, they get 20% of that. They just made $19 million, right? Now, how much of the property's worth? $100 million, right? Goldman Sachs came in and helped you create a REIT and sold REIT stock, and the REIT's worth how much? 196 million, right? How much are these properties worth?
100 million? 100 million. Maybe.
What happened? How come people are paying $196 million for $100 million worth of property? How could that happen?
Perceived risk. Perceived risk that has been pulling the properties together. That is less than that would be just one by one individual.
How much of the property is worth? Right. So here we are in the real estate industry, and when everybody agrees these properties are worth $100 million, Wall Street comes in, and next thing you know, they're worth $196 million. How could that be? Reason is because investors, you're absolutely right, are not getting paid for their risk. If the market says, I want a 7% return on multifamily apartments, and overnight you put it into a REIT and the investors say, well, I'm willing to take 3.2% now instead of 7%, of course it's going to go up. Now, if you're a REIT and you know you can buy these properties for $100 million and make $96 million, right? And you're in competition with other REITs trying to buy the same product, what's going to happen? You know, I'm willing to pay more, right? I got $96 million to play with. Maybe I'll buy them for $105. Maybe I'll propose $110 million. At some point, there's got to be pretty much equilibrium. Not perfect, but pretty much close. And so these prices are going to go through the roof. And that's why cap rates today are not 7%, but they're like 4%. And that's exactly why Wall Street investors, because they package these things up into REITs or funds, they got them to agree that they only wanted a 3.2% return, and next thing you know, cap rates dove. Now, what did I say in my 40 years? What's the average cap rate been?
7.
9. Lending rate 7, equity rate 10, cap rate of 9. We're at 4. And throw a REIT 3.2%. That's what's happening. Okay? Let me talk to you about some sources of money. Israel has first of all, a ton of wealth. Very successful country. I'm not getting into the politics, okay? But innovative, producing a lot of wealth. They have a system where 17.5% of what you make has to go into a pension fund, government-run pension fund. You pay 5.5%. Your employer pays 12%. Now, unlike our government, what the Israeli government does is they say all that money is going to be managed by third parties. And in Israel, it's primarily by insurance companies. these insurance companies are bringing in billions and billions of dollars of pension money. They got to invest it. There's only so many investment opportunities in Israel. There's some, but not a whole lot. So where do they put their money? Well, right now they believe in the safety and security of the U.S. dollars with everything going on in the world. There's a ton of Israeli money coming over to this country. Has been. We work with a number of investors as well. They're trying to protect the principal, number one, and get some kind of decent return on their money. And they're paying 4% cap rates right now. And they're financing them with cheap CMBS money. And you can get a 10-year loan on a brand new apartment building right now for 2.9 to 3.2% in that area, 3.3. But what's the problem again? What did the lawyer say and the mathematician? I can only cut these up if we can have no payments after 10 years. So we've got a 10-year maturity on all this. And you go to these Israeli pension funds and you say, well, I don't want to talk them out of their money, by the way, but you go to them and you say, what are you going to do in 10 years? What if interest rates, what if there's no capital markets? What if interest rates go back up? What are you going to do? What do the insurance companies say? OPM, kicking the can down the road. I'll worry about that when I worry about it. Right now, where else am I going to put my money? Okay? It'll be very interesting to see what happens over the next 7 to 10 years with all the investments, people using all this cheap money right now. Our big concern is we revert to the mean, 10% equity, 9% cap rate, 7% debt. This industry is going to be upside down when all these loans start coming due. Now, you might ask, there's another problem with the CMBS market. If I get to the end of the 10th year, and for whatever reason I can't refinance, maybe there's no refinancing available, maybe rates are too high, maybe. Why don't I just go back to the guy that's running this bond fund that made the loans, that bought my loans, and cut them up in all these pieces? I'll just explain to him what's going on and have him extend the loan. And I might have to pay a big premium and a fee. Why don't I do that? Anybody know why that doesn't work?
It's not the same person.
Many loans are all bundled into a package. They can't just undo one loan.
Not that. The thing they forgot about when Wall Street came up with this grand idea, they said we need to have one servicer in charge of the whole portfolio. So there's one person in charge. You can't have, well, if some of your money went into 3-year money and that's who you talk to, and some of the 6-year money and that's who you talk to, we need a loan servicer. And so they got one group in charge. But what they forgot to do was give them any power. Okay? So when you go to them and say, I want to modify the terms of this loan, they look at you and say, I'm not even going to try. I said, well, why not? He said, because I have to get the unanimous approval of every single person we sold this portfolio to, or their representative. And that's impossible. You can't get unanimous approval that everybody agree the sun comes up every morning, okay? So it's very, almost unheard of, you hear occasionally, but almost unheard of to modify those loans. It's going to be a real problem if you have your loan mature, no capital market, interest rates, cash flows down, whatever the case might be, it's going to be a real problem. So the lesson is, it's going to be a real interesting experience over the next 10 years. The moral of this whole story, though, is when I started off working in this industry, it was driven by local lenders for the most part on the single-family side, making local decisions about local real estate. Okay? You had national lenders, the insurance companies and whatnot, but the single-family side was all done locally. The second thing was everything was driven by the real estate market. And we didn't even know what a 10-year yield was in 1972. We didn't care about the 10-year yield. Why didn't we care? What dictated the rates that we would loan at or borrow at? regulation Q and state lending limits, right? Okay, then now the whole real estate financial markets, capital markets are driven by Wall Street and by institutional investors who don't know very much about real estate. So you got guys with the money driving decisions, making decisions about something they got no business making decisions about. And you're a real estate developer and you know everything there is to know about real estate development, nothing to know about capital markets. You better learn their game. You got to learn their vocabulary and learn how all this works, because it's not the old days anymore. Okay? What do I do with my remote?
Not seriously. I was gonna play a prank on you.
Here we are. Okay. Final thing I'm going to talk about is the Fed funds rate. Anybody know what the Fed funds rate is? Basically, at the end of every day, a bank's either got cash in the bank or they got a deficit. Okay. And they all put their money. They keep their money overnight with the Federal Reserve, and this is the rate that the banks earn or pay depending if they're a borrower or surplus. What's that chart tell you?
Can only go higher.
When did it peak?
1982.
Yeah. What was going on? What did you just learn, Lauren?
Artificial interest rates staying low for too long and then leaving up.
Yeah. Volcker and all those guys deregulated the interest rates. Boom. Everything took off. Now, I've been on a ski jaunt for the last 30 years on a downhill slope. See how it's gone down? And you're right, it can't get any lower, although the other day I invested $60 million in 30-day treasuries. I had extra money that I wasn't going to use. What rate do you think I got on that?
30-day
Less than a percent.
2.
0.2. I had to pay them. I got a negative rate. It was barely, but it's still a couple $1,000.
Why would you put it in?
Where else am I going to put it?
Nowhere.
To the bank?
Mattress.
Oh, for
A mattress. If only I had a big enough mattress. Our biggest fear is you put all that money with one bank. I don't care if it's Bank of America or whoever it might be. Some event happens. How much are you insured for? Okay. I don't care about the yield. It's safe. Pay the negative rate for the first time. I've never ever had to do that before. Okay, so I've been on a 30-year downhill trek. For your next 30 years, would you rather, can we all agree it's not going to continue to go down?
Yes.
Yeah.
Okay. Would you rather it be going up, flat, or if you could, do what I just did and spend 30 years going downhill? Think about it for a minute. What would you rather do?
Do what you did.
Yeah? Why?
I mean, is if it's going, if interest rates are going down, then real estate prices should be going up.
You can make a lot of mistakes and have the interest rate market pay for them, right?
Yeah.
I may buy a project at too high a price, but if rates are going down and cap rates are going down and prices are going up, I can make up for it and appear to be very, very, a lot smarter than I am. Okay? What happens if the rates are going up? You gotta be a whole lot smarter, and if you see mistakes, they're gonna be exasperated, right? How about flat? Well, we've had flat periods in this country. Period from
1994.
you know, you go going back to 45 to what was it, about 50? When it was when Kennedy was killed, 63. Pretty much flat stock market, flat everything during that period. you're just kind of going along and it's not exciting and, you know, not much happening. What do you think the chances are we're gonna stay flat at 0? Not gonna happen, right?
Yeah.
Okay.